Okay. Good morning or good afternoon, everybody. Welcome to Vincents' 2021 federal budget review. So we've titled this year's budget summary as Rethink, Recover and Rebuild. And I think over the last few months, 2020 generally, I think we can probably all agree that there is a little bit of all of those required to get us past the experience that we've had over the last 9 months or so. So just before we launch into some of the technical issues and specific issues that were talked about last night, just the general disclaimer that this is general information at the moment, and I guess that some of that that comment should be pretty obvious as we go through, because this is based on the budget papers and there's not a lot of detail that's usually provided in those. The detail will be in the legislation itself. So,
and I think that's an important point, Kim, is that what we're talking about here is really just proposals until the bill is actually passed through both parliaments, both houses. Yeah. So really, it's presumably this is what will go through based on what we've heard sort of overnight and this morning. But obviously, with all this sort of thing, there's a lot of horse trading that can happen.
There can be, yes. Okay, this is us. So if you want to contact us at any time, then our contact details are there, available for you. And a copy of these slides will be available to everybody after the session. So essentially why we do this every year is just to make sure that we're explaining to people in the best way possible, in simple terms, what the budget might mean for them, how it might impact individuals personally, but also businesses. Pull apart and try and translate some of those announcements, and highlight some of the things that we think people should be aware of. There are obviously things in here that we won't touch on, things in the budget that we won't touch on necessarily, but we think we've picked out the important pieces at this point in time.
And I think it's interesting to note, Kim, that never before have we seen so much detail about a budget before we've actually had the budget. And I say that because this budget actually included all of the JobKeeper and all those sort of measures that were introduced essentially 6 months ago now. So it's quite unique in that regard as far as the budget goes.
Yeah, that's right. And I think the timing's probably contributed to that. May was definitely not a good time to have a budget, because nobody knew what was going on at that point. Now things have settled a little bit. I don't know that we've got certainty, but we're starting to feel a little bit more comfortable in the new normal skin that we're all in. And it's given the opportunity for the government and I guess business to sort of see where things have been and where they might be heading, hopefully in a more positive direction. So just on that, looking at just a general overview of where things are at, I think the budget really showed that we've got a positive outlook for taxpayers generally, and we'll talk through some of the things that have been introduced for taxpayers generally. Construction and manufacturing and businesses, there was a fair bit in the budget for that, both in infrastructure but also in business concessions and the like. Some interesting ideas in relation to, or approaches in relation to, the dealing with young people and the unemployment that they're currently experiencing and how that might be dealt with. Also some assistance for older Australians and regional Australia as well, usually in the infrastructure section where Brett will be talking. From a neutral perspective, I think tourism was probably the one that was not necessarily a positive or a negative outlook. I think they've probably had enough negative for the year. And but tax specific, there wasn't anything in particular that was announced last night in relation to tourism. From a negative outlook perspective, I think the economy pretty much has to rate there, because the economy has suffered quite significantly, as we all know, over the last few months. Brett will go through what some of that really means. The job seeker rate is a thing that's been in the media quite a bit as to how that's been dealt with. The new start going to job seeker and then going back, and what impact that's going to have on the people that are receiving that. The climate didn't really get a lot of attention, so we will see how that pans out over the next little while. It's we've had an urgent crisis to deal with. We'll see when the climate gets to emerge as a crisis again. And women and migration are also probably on the negative side of things. One of the interesting things I found out last night was that our net migration is going to decrease over the next 12 months by about 150, 160,000 people. 12 months ago, there were expectations of our population increasing significantly over the next few years. But in 2024, the population is actually going to be 1 million people less than what they expected it was going to be when they forecasted 12 months ago. So that's a fair hit, and that's not just migration. That's people coming into the workforce. That's families growing, etc. So there are a lot of things, a lot of moving parts in all of this to be able to work through.
And obviously that impacts on tax revenues. And just generally how the economy performs, because without migrants spending money and earning money, then the economy can't grow.
That's exactly right, yes.
And I suppose we'll look at now essentially some of the economic data that came out from the budget last night. Now, what I think is quite interesting is that our net debt in 1 year has basically, it'll be increased by $213 billion. That is with a B. So that means that right now we're sitting at almost 700 billion in debt. Over the forward estimates for the budget, that'll grow to just under $1 trillion. Now, there's no denying that the government had to spend that significant amount of money to essentially keep the economy going. And I think that what we'll see shortly is that what that has really meant is that we have weathered, the economic conditions reasonably well. Obviously, this debt has to be paid back over time. That'll be the challenge, is that where that turning point becomes. The budget papers refer to an unemployment rate of less than 6%, is when essentially a lot of the measures will start to pare back and will really look to drive that debt down again. And hence why you sort of see it tailing off over the next sort of 4 years. And remembering that in last year's budget, they were actually predicting this year's budget to be in surplus. So it's basically a $220 billion turnaround in 12 months.
Yeah, so I think if 2020 has probably taught us all a lot of things. One is to expect the unexpected, and the outcome, I think, will be to also learn some patience, because this isn't something that is going to be able to be dealt with overnight. Money is cheap at the moment, but this is going to take some significant period of time to actually get back in the black, as the government was trying to achieve as of last year. It just goes to show you've got to anticipate all sorts of things.
Yeah, and even this year, Kim, back in March, the Prime Minister was talking about a V-shaped recovery to our economy. Now, clearly that isn't going to happen.
No.
It is going to be some time before we're back to basically where we were.
Yes, that's right.
Now, this here, it looks rather busy, but it's quite an interesting graph insofar as it looks at the real GDP data for actuals for 2018 and 19, and then what has essentially forecast for this year and next year. Now, obviously, I won't say I've cherry-picked economies, but I've picked out the major ones, essentially, in looking at this. And as you can see, Australia's reduction in GDP, which is our gross domestic product, how much our economy is growing, positive is a growth. Australia is actually faring quite well in being around that. It's probably somewhere between 1.5% to 3% is roughly where they're expecting it to land.
Faring quite well. I think that it's all relative, isn't it? If we compare to everybody else, there are people doing it quite tough, but compared to the rest of the world,
yeah, definitely,
we're doing okay.
Yeah, and some of that is, I think, because of the measures that were put in place as early as they were, and some of it was probably because the way we've managed the actual COVID-19 pandemic itself. So I think there's two elements there that have really worked together, and obviously being an island nation sort of helps a fair bit. Has really helped in almost quarantining the economic impacts by and large compared to some countries. And then a little bit of perspective, we were talking about the debt the debt before at 213 billion this year. So the debt to GDP ratio for Australia, we're actually ranked 123 of 184 in highest to lowest. So in other words, we're basically in the bottom quarter of all countries.
Okay.
So Japan's almost 250 billion. Oh, sorry, 250%. Right. Now, this is actually last year data. Yeah. So it's only going to get worse as countries introduce stimulus and that sort of thing. So America, for argument's sake, they're talking about what, a $2 trillion stimulus package. So these figures here don't even include that.
Yeah, and they're numbers that are just so hard to comprehend too, as to how many zeros are on the end of these things.
Yeah, exactly. So Australia alone is going from a 41% in this graph to a 51%. Mm. So if every country has a 10% jump, then bottom line is we're feeling very well.
Yeah, that's right. Okay, so we'll step into some of the specific tax measures that were announced last night. The first thing that I wanted to talk about was personal positions, so personal tax cuts. You might remember that a couple of years ago, the government legislated, I think it was in 2018, that they would have a staged reduction in personal tax rates. So they were scheduled to commence, or these stage 2 of those personal tax cuts was scheduled to commence on the 1st of July 2022. Last night, the government announced that those stage 2 tax cuts would be brought forward to the 1st of July 2020. So that's what people have been hearing in the media over the last few days, that people will immediately start seeing tax cuts, that the government's going to essentially change the tax tables for employees so that they receive these tax cuts now. It's quite unusual to have tax cuts for a current year to be introduced partway through the year. So we'll see how that all progresses. But essentially, the 2022-23 tax cuts have been brought forward to this year. So what does that mean? Sorry, Brett.
No, I was just going to say, so I presume that for some of the software providers that do payroll, they'll actually update the tables automatically. But there's going to be some small businesses who perhaps don't use a Xero or a MYOB reckon to do their payroll, so they're going to have to manually adjust those calculations once the legislation's approved. They will, and the ATO will publish those tax tables so that they've got some reference to that. But yes, essentially that's what's going to happen. Yeah. And my understanding is that it's supposed to flow through the entire year, so it's not really starting from today to the end of the year, that they're being adjusted in such a way that you will receive the bit that really applied from the 1st of July to today as the rest of the year progresses. So what does it mean? So these stage 2 tax cuts mean that the top threshold of the 19% bracket is going to increase from 37,000 to 45,000, and the 32.5% bracket is going to increase from 90,000 to 120,000. So in addition to that, there's also the low income tax offset that has been brought forward to 2020, 2021, so the current year. And the low and middle income tax offset that was supposed to have ceased, it has been retained for the current year. So the low income tax offset, you get a maximum of $700 if you meet the criteria. And the low and middle income tax offset, you can get a maximum of $1,080, again, if you satisfy that criteria. Now, there was a third stage to those tax cuts that were announced and legislated in 2018.
From July 2024, they'll essentially remain unchanged and commence on the 1st of July 2024, as was previously legislated. So from that date, the 32.5% rate will be cut to 30%, and the bracket will be between $45,000 and $200,000. The 37% rate will be abolished, and so we'll effectively be left with three personal tax rates: 19%, 30%, and the 45%. There is that tax-free threshold in there as well, obviously. The idea is that most of the population will fall within that 30% range, which will be akin to, or more akin to, the corporate tax rate. So it's sort of flattening out that arbitrage that might otherwise be gained between structuring.
But we're not going to see those for another 4 years, though.
That's right.
Yeah.
Like I said, 2024 they'll start.
Yeah.
One item that has been talked about in recent times is in relation to CGT and granny flats. You know, there are a number of different solutions being sought by families to appropriately care and house older family or people that have got a disability. And there was a tax issue in the sense that, you know, it created a CGT event. So from July 2021, the creation, variation or termination of a granny flat arrangement will be exempt from CGT where there are certain conditions that are met. So the accommodation has to be provided to older Australians or those with a disability. And I've put an asterisk next to both of those because neither of those words are defined in the budget papers. So we'll see what that means. The other important aspect to gaining this CGT exemption status is that there has to be a written loan agreement in place. Now, at the moment, there are a number of these arrangements that are around that are undocumented, and there's been a concern expressed that people could be being taken advantage of, and essentially providing this exemption and forcing people to enter into a written agreement will help prevent some of those people being taken advantage of, and, you know, the elder abuse that we unfortunately hear about more and more. These agreements have to be between family arrangements and also other personal ties. So where there isn't family involved, then you have to have some sort of personal tie. So we'll see how that is detailed in the legislation. One interesting thing I'll be curious to see is how they integrate these rules with the main residence exemption rules, because there didn't seem to be any comment last night about how the main residence exemption rules would be adjusted in relation to these rules.
Now, I think for the first time ever, Kim, this is the smallest superannuation slide I've ever had to produce in probably 10 years that we've been doing the budget webinar together. And for that, I am grateful, I will admit. And more so than what they're essentially talking about really impacts on the larger super funds and individuals personally in what they're trying to achieve. So essentially, the government is looking to introduce a Your Super comparison tool. So what that really is going to be a website where you can log in and see how your My Super fund, and it's important that it's only going to be targeted to the My Super, which is the low-cost, dumbed-down version of super funds that is offered out there in the marketplace. So you can see how they perform against your fund. So to try and make it more transparent, if you like. There are websites already out there that do that, but this will be a government initiative to do that. And I think they're also looking to have greater transparency around super funds. A couple of really interesting things here, which quite clearly they're trying to, I'll say, stick it to the industry funds, because the government has some umbrance with union-backed super funds. And they relate to around sponsorship, basically, of reading between the lines of super funds. So for argument's sake, the Melbourne Storm is sponsored by Host Plus. You have Sun Super, who sponsor the Riverfire fireworks here in Brisbane.
And the netball.
Yeah, that's right. So I think they're really trying to emphasise the fact that super shouldn't be about advertising. It should be about for the members' benefits. So that the language they're using is that to make sure that the super funds are for members' benefits. So I think they're really targeting that sort of sponsorship stuff. And also, if a super fund doesn't actually achieve a particular annual return, and we don't actually know what that's going to mean, whether it be a fixed amount or an index to something, then if the super fund doesn't achieve it, they have to write to the members and offering them an alternative. If they don't meet that criteria for multiple years, then they won't actually be allowed to accept new members until they turn that around. So it's a real interesting scenario, particularly around that whole investment piece, because it's basically saying that, you know, if you don't perform, then we're going to essentially lock you out.
Right.
Okay. Yeah, which is quite interesting.
Interesting. Yeah.
And then finally, around that whole transparency piece, the APRA funds will be required to provide more information to members each year in relation to almost like financial statements, not unlike what a company does before they when they release their annual financial statements.
Okay.
They've got to make that information a bit more transparent.
Hopefully understandable as well.
Well, yeah. Well, let's not get our hopes too high on that. And then finally, I think a really interesting initiative is this idea of locking super into individuals. So superannuation has always been essentially the product of an employer. So the employer, by default, could choose a super fund when they had an employee start, and it was really up for the employee to say, hey, this is actually where I want my super to go.
Yep.
On average, Australians have about 2.4 super funds, and this is why, because people, particularly younger Australians, those in casual employment, will have multiple super funds and they'll lose track and that sort of thing. For the past few years, the government's had this drive to consolidate super. What they're actually trying to achieve now is you have a super fund that is linked to you. So they use the terminology stapled to you. So when you start a new employer, they have to pay into that old fund. Mm-hmm. So look, the mechanics behind this is going to be quite interesting. Whether it's going to be linked to your tax file number or something like that potentially, because most people don't actually know who their super fund is, particularly if you're a casual.
Right.
But what they're suggesting is that this will save almost $18 billion over 10 years through administration fees, because people not having multiple accounts. Yeah. So not a lot of, and there's no time frames around any of this in the budget papers. So it'll be interesting to sort of see where it goes and how quickly it runs too.
Okay. All right. So as far as businesses are concerned, there was, as I think we all expected, there are quite a number of measures that were introduced last night, a number of which we had already heard bits and pieces about, if not all about. One of those was in relation to expanding access to a range of the small business tax concessions. How this has been, well, part of how this is being done is increasing the small business entity turnover threshold from $10 million to $50 million. Now, the way that these turnover thresholds and the impact that that increase in turnover will impact on businesses is staggered over the next 12 months. So from the 1st of July 2020, there'll be an immediate deduction for certain startup expenses and certain prepaid expenses currently allowed for small businesses, but with the threshold expanding, then that opens that up to a lot more businesses. From the 1st of April 2021, the FBT exemption on car parking and multiple work-related portable electronic devices, so mobile phones, laptops, etc., will also be expanded to businesses that meet that 50 mil turnover test, or less than 50 mil. And from the 1st of July next year, there'll be a number of other small business entity concessions that will be available for businesses with less than 50 mil turnover. These will include things like the simplified trading stock rules, the ability to remit PAYG based on the GDP adjusted notional tax. There are some excise and excise equivalent customs duty reporting issues, so allowing them to be able to be done monthly. The Commissioner will also have the power to create a simplified accounting method or determination for GST. That's going to be expanded to these businesses. And interestingly, the time limit to amend tax returns will be reduced from 4 years down to 2 years. I found this one quite interesting, that as people know, with businesses, business entities, then the amendment period is generally 4 years. And for individuals with very simple affairs, it's 2 years. So if you are a small business, then you've got that 4 year window that's open for the Commissioner to challenge something, or alternatively for the taxpayer themselves to go back and amend something. The proposal is that will change to 2 years, which will limit the opportunities for amendments by the taxpayer and by the ATO. Interesting that it is only going to apply, or at this stage it seems to be announced that it's going to apply to small businesses. So entities that aren't businesses, investment entities, won't fall under this change. So it's something to keep an eye out for. We might see a lot more timely audit activity, I suspect, from the ATO to review returns, etc. for businesses.
They're going to have to, aren't they?
They will, yes. The other announcement last night, which is really built on the announcements that were made earlier in the year, relates to capital allowances, so depreciable assets. So where a business has an aggregated turnover of less than $5 billion, so that's a B, so $5 billion, they can deduct the full cost of eligible capital assets that are required after 7:30 p.m, that should say, daylight saving time last night, so budget time, provided the asset is first used or installed by the 30th of June 2022. Now there's a full expensing of the item in the first year that it's being used, and will apply to new depreciable assets and the cost of improvements to existing eligible assets. If, however, the business has an aggregated turnover of less than 50 million, so a new small business, then it also applies to second-hand assets that are acquired. The aggregated turnover between, or entities that have an aggregated turnover between 50 million and 500 million, they can still deduct 100% of the second-hand assets purchased prior to the 31st of December 2020. They're the current rules that were talked about earlier in the year. And if they hold those assets that are eligible for the $150,000 write-off, the intention was that they would only have till the 31st of December this year to first use or install the asset. And that period's been extended by 6 months to the 30th of June next year. Now, where entities have got aggregated turnover of less than $10 million, then they're able to deduct the balance of the simplified depreciation pool at the end of the year in which the full expensing applies. But they can also re-enter the simplified depreciation within that 5-year period that, under the normal rules, was prohibited. So that's been suspended, or continues to be suspended at this stage. I guess over the last couple of slides I've talked about aggregated turnover a little bit. The aggregated turnover increasing from 10 million to 50 million, aggregated turnover of less than 5 billion. It's important to remember that turnover doesn't just relate to the entity that you're looking at. It relates to that entity, all the entities that are connected to it, or maybe affiliated with it. So it goes back to those definitions in Division 328 that originally tied back to the small business CGT concessions, being very much more widely used these days and quite critical to get your head around. Can be challenging sometimes, but becoming increasingly important to make sure that you can satisfy these threshold tests to get access to some of these concessions. Now, another interesting approach that was proposal that was raised last night was in relation to the company loss carryback rules. Now, it does relate to companies. It doesn't relate to non-corporate entities. This took me back a little way to, I think it was 2013, that the 12-13 year that we had loss carryback rules. So yeah, it took me back a little bit. This version is supposed to apply from the 1920, the 20 financial year, the 21 financial year, and the 22 financial year. And what it does is it'll enable companies to carry back losses to offset profits against the profits that they derived in the 2019 financial year or later income years. So you can't go back any further than 2019. The effect will basically be that the tax that was paid in respect of, say, the 2019 year can be refunded, but the amount that can be refunded can't exceed the tax profits of that year, and it can't generate a franking account deficit. The refund's going to be available to companies that make an election when they lodge their return for the 2021 year and the 2022 year. So you have to elect to take part in these loss carryback rules. If you don't make an election, then you can continue to carry forward your losses as normal. So there'll be no change there.
And Kim, this might be one of those devil in the detail questions, but will the taxpayer be required to go back and amend that prior year return, or will the election essentially just deal with it as part of that process?
I think it'll deal with it as part of the process. Right. Yeah. Going back and amending returns will create an administrative burden that's really unnecessary. I think that it can deal with it in the returns for over the next couple of years will look a little bit different to try and accommodate that information. So we'll see what the election looks like and how it might be a separate form.
Yeah.
Rather than in the return itself.
Yeah.
So. A technical amendment that's being made is in relation to how we determine whether a company is a resident of Australia. It's really a technical amendment that arose out of a High Court case back in 2016 called Bywater Investments, where the court essentially departed from what the long-held definition of a corporate resident was for Australian tax purposes. Without going into the detail, there was a ruling that has been around for a number of years, back in 2004, TR 2004/15, and Bywater essentially went against everything that we'd thought was the approach to be taken for corporate residency. So where a company is incorporated overseas, we always had this issue of whether they were a resident or not may depend on where their central management and control, whether that was in Australia or not, amongst some other things. This new test is going to rely on the company having significant economic connection with Australia, and also that the core, I think underlying all of that, is that the company's core commercial activities have to be undertaken within Australia, and the central management and control is in Australia. So they're hoping that with this change in the definition, we'll move away from the confusion that's reigned since Bywater and the different approaches that people might want to take as a result of that case. The change is supposed to take effect from the first income year after royal assent is granted, but companies do have the option of applying the new law from the 15th of March 2017. which was essentially after the Bywater Investments case, the ATO withdrew their tax rule in 2004-15. They also had a ruling issued in 2018, I think it's TR 2018/5, that also talked about central management and control, etc. So there's a lot of stuff around in relation to this issue. Hopefully by fixing the definition will assist us in dealing with those issues for corporates that come in from overseas.
I find the timing around this curious, Kim, particularly in this type of budget. And I'm wondering if it might actually be because of a number of people essentially stranded overseas and their personal residency, and whether that's a catalyst for them dealing with this now.
Yeah, well, there's been a lot of discussion over the last 6 months about residency in the context of people that are trapped here or trapped overseas, and how that impacts on both their personal affairs, but also the management of companies that are located all over the place. So, yeah, it's definitely come to the fore over the last few months, that's for sure. Retraining costs, in the current environment, we've got lots of unemployment. We've got people that are being put in positions, redeployed into positions that they, because their existing position is no longer available, and it's made people more aware, I guess, of the fact that we need to retrain and reskill some of our workers, whether that's because of the particular individual circumstances or immediate circumstances, I should say, but also thinking about, well, what are we doing in the future? How has this event over the last 6 months or so changed the way that we're going to go forward, and what do we need to have in our arsenal to help the business move forward? So retraining costs where they don't relate to an individual's current employment and their role are usually subject to FBT. So the government is proposing an exemption for providing retraining and reskilling benefits that are being provided to these redeployed employees, so people that might be redundant or soon to be redundant, where the benefits aren't related to their current employment. So that will enable or hopefully encourage employers to start training some of their staff to do different things from what they were doing in the past. It won't extend to retraining expenses that or benefits that are provided as part of a salary packaging arrangement, or Commonwealth supported places in universities and student loans, etc. And it will apply from the date of the announcement, which was the 2nd of October, so not budget night, but the date of the announcement. Also, in the context of retraining costs, I'm sure many of us will be aware of the deduction that taxpayers can get for self-education expenses. Getting that deduction, or being entitled to that deduction, relies on the self-education expenses relating to your current role, your current employment. There are going to be a lot of occasions, a lot of individuals out there where they may not have current employment, or they're trying to reskill to do something else to prepare for the future. So the government is going to enter into some consultation about claiming education and training expenses that aren't related to current employment, to see how that might best work for individuals. This one, FBT, sort of surprised me. I think that FBT has been around for a long time now, I think 1986, and there's not been a lot of tinkering that's gone on in the FBT space. But this one, it threw me a little bit. The proposal is that we're going to simplify record keeping requirements and enable the company to rely on the corporate records that they have, rather than getting employee declarations or some other prescribed records from the employee. It's something that I think anybody that's involved in FBT can relate to, that the record keeping requirements are a little ridiculous at times. This will hopefully help businesses and their advisors trying to deal with some of these requirements. And this is going to be effective from the 1st of April following the date of royal assent. R&D, for those that are involved in the R&D space, this here is a slide that we did about 3 years ago in relation to the R&D changes as they were announced at the time. Now, the bills that introduced those or these changes to the world have taken a long time to get through Parliament. Never really got to find the other end of the tunnel, and as a result, last night there were some changes that were made to the bills that, as they're currently proposed. So what that's going to do is to basically, for entities that have got an aggregated turnover of less than 20 million, their refundable tax offset is going to be set at 18.5% above the company tax rate. The bill currently provides for 13.5%, so that's a significant uplift in the percentage that's going to apply. Under the proposal in the bill, there's also a $4 million cap, and that's been taken away, so that's not going to proceed. Where businesses have an aggregated turnover of $20 million or more, there were a number of intensity bands that were referred to as the amount of R&D that was undertaken by the business. I think there were 3 bands that were introduced or proposed to be introduced. They've been simplified. There's only 2 bands now. So where the intensity band percentage is between 0 and 2%, then there'll be an R&D tax offset premium of 8.5%, and where it's more than 2%, you get the 8.5% for the 0 to 2% band, plus 16.5% for the additional above the 2%. So hopefully it won't take as long for these changes to go through Parliament as the last ones have taken. But that's a bit of a summary of where we're at with that.
Yeah, I think what's interesting, Kim, we're talking about this, an omni bill, basically, where they're bundling all of the business changes, the personal cut changes, essentially all together in one bill to present it to Parliament, presumably today or tomorrow.
Yeah.
So that way it's harder really for the opposition to critique it or not pass all of the measures at once, because it's linked intrinsically to the personal tax cuts.
Yes.
So they're sort of using that as the political stick, I suppose, to get it through both parliaments.
That's right. You can get into the politics of pulling it apart, but that's not what the country needs right at the moment. So it is a bit of an incentive for everybody to get cracking and get it done.
Yeah, and it seems that Labor are committed to passing particularly the personal tax cuts. So by and large, that means that all of the business measures will go through.
That's right. Yeah.
In last night's budget, there was a number of infrastructure spending announcements that were put forward. So since March this year, the government has announced around about $14 billion worth of infrastructure. Now, last night they announced $7.5 billion for transport. Now, apparently this is all new money, but there's been some conjecture around some of it, Kim. But basically, and those transport costs are spread throughout the country. The slide there basically highlights the bigger numbers. In addition to that, there is also $3 billion of what they've termed shovel-ready projects. So there's $2 billion for small-scale road safety projects, as well as $1 billion for community or local roads. So this is for city councils. So $2 billion for state government to fix up some roads, and $1 billion for councils to also do the same. And then there's another $500,000 that they've already announced. So that sort of goes to that as well. So $500 million. So there's, I suppose, a fair bit of money that's being kicked around infrastructure. My personal belief is it should have been a lot more, because Cross River Rail here in Brisbane, that's about $3.5 billion. The metro is about 1.5. So 2 infrastructure projects have almost totaled the government's new commitments. To me, I just think it's a little bit short-sighted at this time.
Yeah, I think so. I think, as I said before, it's been an interesting year. So having the budget in October, we've got another one in May next year. If this doesn't work, then there's an opportunity in the not too distant future to tweak things or make some radical changes. So I think that might have been part of the thought process behind it all.
Yeah, true.
So the last major thing I wanted to talk about was an addition to the job family. I think we've had job keepers, we've had job seekers, and now we've got job makers.
Don't forget job savers.
And job savers, that's right, yes. So last night there was a JobMaker hiring credit proposed. What this is a $200 per week or $100 credit per week that's provided to an employer, and it's available for up to 12 months from the date of employment of a new person that increases the employee headcount and the payroll of the entity. It relates to additional jobs that are created from today, so from the 7th of October 2020, and it relates to eligible employees aged between 16 and 29 years, so you'll get a $200 credit per week for new employees that are aged between 16 and 29, or you'll get a $100 credit per week if the employee is between 30 and 35 years. The individual has to work for a minimum of 20 hours per week, and that's averaged over the quarter. And importantly, the employee must have received the job seeker, youth allowance, or a parenting payment for at least 1 month out of the 3 months prior to their employment engagement. So you can see that it's aimed at getting people off job seeker, getting people back into the workforce, and building the workforce over the coming months, over the next 12 months or so. There is a fact sheet there that I've referred to that provides a bit more detail as to the eligibility requirements, etc. But again, the devil's going to be in the detail. There are quite a few eligibility requirements from the employer's perspective, as we would expect. From my glance at it this morning, it seems that it's similar to the job keeper type things from an employer perspective, having to have an ABN and be registered for single touch payroll, registered for PAYG withholding, all of those sorts of things. So yeah, something to keep an eye on, and maybe of benefit to some of our clients or your own businesses. And just quickly, a few other things that were mentioned. State COVID-19 business support grants, such as the one that was being introduced in Victoria, will be regarded as non-assessable, non-exempt income. Now, other states don't have these business support grants. There's the particular ones that are being referred to at the moment, but if a state requires it for some reason, then the government has said that it will, they can apply for it, and if it falls into the same basket as the Victorian one, then it'll be treated in the same way. It's a wage subsidy for new apprentices, additional funds for the tax office. Surprise, surprise.
About 600 million, it looks like.
That's right, yes. Having said that, they have done a big job this year, so and as I think a lot of people have. There'll be two $250 cash payments for income support recipients. The first one to be received in December and the second one in March, I think, next year. On the flip side of that, deeming rates for pensioners and the like, there's going to be no change to that. And youth allowance, people receiving youth allowance and ab-study allowances, there'll be some incentives for the independence test if they undertake some seasonal work. So the government's been talking about us not having enough fruit pickers, etc., for the summer. Then this seems to be aimed towards that.
Right. Last night it was mentioned about the new consumer credit reforms that the government is looking to introduce. Now they released these a few days ago, and there's no detail around it whatsoever because it's going to go out to essentially consultation. But they want it in place reasonably quickly, so by April next year. Now, presumably that is about trying to ease up the lending requirements to make the consumer able to borrow money a lot easier. So it's all about removing red tape, and look, essentially it's about not requiring the financial institution to satisfy a reasonable test. So in other words, if the consumer tells them that this is my income or this is my expenditure, then the financial institution can basically rely on that. So they don't have to then go and analyse bank statements and all those sort of things like they currently do. So it's about trying to free up the borrowing process to make money easier to obtain.
Okay.
In theory, it's then about spending that money, so all about generating economic activity.
Yeah, just keep things moving.
That's right.
That's right. So there's a copy of our federal budget report on our website at the moment. There's a link to it here in the slide deck, but you can find it on the website. So feel free to have a read of it. If you've got any questions about the things that Brett and I have spoken about today, then feel free to give us a call. Before we go, we just wanted something that wasn't mentioned a lot last night, but I think is important in the context of where we're at and the things that were announced last night. So there are a number of insolvency reforms that have been announced recently that can impact on how businesses fare during this experience that we're all having. So we thought we'd invite Louisa Sijabat along to today just to give us a quick summary of how it might impact on businesses and things to look out for, things just to be aware of in the context of the budget last night, but also just where we're at the minute. So I'll hand over to Louisa.
Hi, thanks Kim, thanks Brett. So for those of you who don't know me, I'm Louisa Sijabat. I'm a liquidator and bankruptcy trustee. I lead our insolvency and reconstruction practice for Vincents here in Sydney. So as Kim mentioned, there have been some very significant insolvency law reforms for small businesses that the government announced in late September 2020 to be effective from 1 January 2021, so very quickly. So as with the budget, these insolvency law reforms are all trying to head the economy in one direction, up. So just the same way that the budget supported, businesses and growth through various things that they'll do to help subsidise employee costs, apprenticeships, all these sorts of things. The insolvency law reforms for small businesses are targeted in the same sort of way to keep businesses in business as much as possible, so that jobs can be maintained, so that consumer spending can continue and that cycle of economic activity upwards can continue to get us out of this recession. So who does this apply to and who needs to pay attention to these? So the new insolvency laws will be eligible, the people eligible to participate or to use these new insolvency laws will be small businesses who are incorporated, so they must be in a company structure. They can't be in a sole trader structure or partnership structure, and they have to have debts of $1 million or less. There is yet to be some clarification to be released around what's included in that $1 million of debts. Will it include contingent debts? Will it include related party debts? Will it include secured debts? So we're waiting for a little bit more information from the government in that regard. These small businesses must have also paid all their employee entitlements in order to use this system. So the system proposed is a new restructuring system where in 20 business days, the eligible small business, together with a restructuring professional, say somebody like a registered liquidator, can put together a plan for the debts of that business. And the key point is, while the business keeps trading under the control of the existing directors. So right now, if a company goes into liquidation or voluntary administration, control of the trading business is handed over to the liquidator or administrator. So the big change is that the directors would stay in control of their businesses. There are definitely some positives to this, which is the directors know their businesses better, and they can continue to trade their businesses usually at a much lower cost than what a liquidator or voluntary administrator would charge to do the same thing. So they have 20 business days to develop a restructuring proposal together with the restructuring professional to put to their creditors, and creditors get to vote on this proposal. However, the precondition before creditors can vote on the proposal is that all employee entitlements that are due and outstanding and owing by the business must be paid. So this creates an interesting area, because sometimes businesses who are struggling to pay their debts do typically fall behind on things like superannuation. So it'll be interesting to see if there's any, say, funding market that arises to fund these employee entitlements so that the business becomes eligible to use this simplified, lower cost restructuring system that the government is bringing in. So once the conditions are met, the plan is put to creditors who have 15 business days, so about 3 weeks, to vote on it. In order for the plan to be accepted, 50% in value of creditors must vote in favour of the plan. Related party creditors are excluded from participating in the vote for the reason put forward, so they don't sway the vote, I suppose unfairly would be the aim. Although, having said that, related party creditors, so this is relatives of the director, related companies, are typically quite a key funding source for small businesses in Australia. So there can be some genuine debt there for related parties that might not get voting recognition, or probably won't get voting recognition as part of this. So if the plan is accepted by 50% of creditors or more, then the business begins making its repayments to the restructuring professional, who on-distribute them to the creditors. If creditors don't accept the plan, then the business can enter into a simplified liquidation process, which is meant to be lower cost and less investigations, less regulatory requirements, to keep the cost of liquidation down, with the aim of being that any assets left in the company, as much of them as possible, can go to the creditors of the company instead of being soaked up by liquidators' professional fees. So super high level overview there. Lots of detail yet to come. There's lots of questions yet to be answered as well. So if you've listened to that and had any touch points with liquidation or insolvency, you probably do have a lot of questions. We have the same questions right now as well. So we don't know too much right now, more than that. But as we do know more, we'll be providing updates through our website and through other channels as well. Back to you, Kim and Brett.
Excellent.
Thanks, Louisa.
Thanks, Louisa.
Well,
yeah, I think that ties in well with the budget. There's a lot of things that can be done. There's a number of businesses that are struggling at the moment. We may not have all of the rules at the minute, whether it's the budget or the insolvency rules. But if you are struggling, then there's probably somebody here at Vincents that can help, whether it's formal restructuring, in Louisa's sort of area, or in our business advisory area, the tax technical or superannuation area, then Brett or I can help. So it's there's a number of opportunities out there for businesses that are struggling at the moment, or just looking to grow. So we'll see what the legislation actually looks like. The devil is always in the detail, but we need to keep moving along anyway. So yeah.
That's right.
Okay. Well, thank you everybody for attending today. We hope that you got something out of the session, and a bit more of an understanding of what was in last night's budget. There'll be a lot more information coming over the next few days, I'm sure. And as Brett said, we're hoping the legislation will be introduced today or tomorrow. And it sounds like it's likely to be an omnibus bill, so that'll be quite a hefty document, I expect, that we'll be trying to explain how it all fits together. So when we know more, we will share more via our various social media channels, etc. So looking forward to catching up with everybody. Okay.
Thanks for joining us.
Thanks, everybody.